Hey, what's happening YouTube? Hope you're doing well. It's Friday the 17th, and we will do a little video now. So the market just closed. It's 4:05 p.m. I took a couple scalps into the close, but nothing notable. Honestly, I really just wanted to come through and watch the close and look at a couple of things. So I'm going to show you something here. So let me just minimize this stuff and take a look at the options chain real quick. Now, I want to teach you something about options and the fact that this is a phenomenon that I've realized over some trading experience I have trading options. All right, what I've noticed is that the options contracts that trade the highest amount of volume generally expire worthless or close to zero. All right, so as you can see here, this is the options contracts for the triple Qs, the Nasdaq ETF, and you're going to see here the 260 strike traded the most volume on the call side, and on the put side, well, we had the 255 puts and a bunch of other strikes that also expired worthless down here, but closest to the money would be the 260 puts, and then I guess close to here. But generally there was a lot of volume on the call side here, and that was quite notable. So I was watching this especially as we were going into the close of the market. And I noticed that we had a little pop earlier, and basically we popped above our daily high for a little bit, and then it got rejected pretty soon after, and then pretty much we had this massive bull spike, I guess to get a bunch of bulls on board and grab some liquidity up above the high of the day, and then we slowly started to fade. And of course I was watching this according to the triple Qs, and the triple Qs at that point would have pushed above 260.14 all the way to 260.31, and that would have made this 260 strike in the money by 30 cents. Okay, so this 260 strike was now trading probably around 80-90 cents a contract, and now as you can see it expired worthless. So now this is just something I've noticed from a lot of time looking at the markets and looking at the options chain on Friday expiries, and it's the fact that the options with the majority of volume tend to expire worthless. Now again, I'm unable to explain the phenomenon behind it, but what makes sense is that, okay, so let's try and analyze this from a logical perspective here. So the majority of options contracts that trade in a given day are bought, which means that they're bought by either retail traders or institutional traders or speculators, okay? Now, who is selling these option contracts? Well, you have to understand that it's market makers and institutions. So the institutions, their job essentially most of the time is to sit there and provide liquidity in options markets, and often they hedge themselves by using futures and stock to hedge their options positions. Their job is to provide liquidity for the speculators in the market, okay? So let's just understand this from a logical perspective. If the people with the most money are providing the liquidity, then why wouldn't they use their most money or infinite money to essentially manipulate the options that they were short in a way that they compensate for the premium that they sold to make sure it doesn't get too out of hand, okay? So this is just a logical concept. So again, the people providing liquidity will in fact use money to compensate for when options trade a lot of volume and kind of get out of line. So again, it's just a simple concept. When options trade a lot of volume, they tend to expire worthless. All right, now I want to hear your guys' opinion about this in the comments below. If you guys have any insights about this, just put it in the comments below, okay? It's just an interesting thing, and it's quite notable. And this is why I think that if you trade stock or futures or anything involving the US equities market, you definitely need to keep an eye on the options volume and the options market in general, okay? And that's going to be on your big tech and on your big ETFs. All right, let's go on to the trade review now. All right, guys, here we go. These are the results for the week. So green every day except for today, in fact. And today was a bit of a mixed one, and we're going to go over that here in the video. So as you can see here, the win rate is quite good, just under 70% there, and I'm going to show you the Excel document for today. So today was a red day, in fact, but I had 18 trades in total, and the win rate was about 50%, give or take, okay? So I have a strategy that works, and that's what counts. Now it's just a matter of controlling this. That's going to be the number one thing now. I'm having a lot of success in the way I'm trading right now, but my worst enemy is tightening ranges. When the market is kind of in these chop consolidation ranges, there's certain opportunity, but other times there's less opportunity. And the trouble with my trading right now, it's basically knowing when to not trade it and when to just take a step back, go outside for a walk for 10 minutes, let it play out a little longer, and then come back, okay? Because look, there's a lot of opportunity. In the style I'm trading now, there's a lot of opportunity to trade on any given day, because the strategy works when the market's in trading ranges, when the market's in trending, when the market's shopping around, stop hunting everybody. It's great, actually, and it fits me quite well. That's why I enjoy trading this way. and it works very well on this market that I'm trading, which is the Nasdaq, okay? But the thing is, not every trading style is perfect, of course, and you have to understand the weak points. And the weak points where the strategy fails is where the market is in these little accumulation phases, and we're seeing these little mini fake outs and no notable direction, okay? And we're gonna go over that a little bit. So let's just go through the video here first and we'll find out my trade. So this is the opening of the Nasdaq. We trade lower again for a second leg down, and now watch this little rally here, a little fake rally. And basically I've seen this pattern occur a number of times where we're in an overall downtrend, and of course bulls are going to look to answer here. Bulls are going to look to say, I see an aggressive bull, okay, it's time to buy the dip. But I want to see how the sellers react when we get back to about the 600 mark. So watch this. I'm looking at the liquidity down in the lower part of the market. See how it's kind of accumulating? Sorry for the scrolling, guys. And there we go. Look at that. That's what I was looking for right there. And that was enough for me to get short. And I was looking for another leg down, another little stop run. So you're seeing how it's kind of struggling again now, back above these 80s, 89s, but I want to see a push down to 80 and lower. I've been in the trade for about 15 seconds at this point, not quite what I'm looking for. The sellers are answering and they're having trouble with it. Sooner or later they push it. There we go. That's what I was looking for. So I get out around 75. I get filled at 75. I had my stop at 73, 75, and I got filled on the market order at 75. Let's take a look at this trade. So you can see how basically this is the pattern I was watching, and there was a lot of sellers around these 610s if you were watching the tape earlier today. And basically every time they would pop it, they would always be sitting there absorbing the buy liquidity, and sooner or later the market traded lower to these 590s. So I would consider this the first leg down, and we were an inside bar after that. Now let's look at how the market trades afterwards. See, we bounced all the way from that 580 something all the way up to 595 or so, and now we're sort of trading sideways, and the buyers are still pretty weak at this point, okay? So until the buyers can show notable strength, there's no reason to really get long in front of this. So you can see some buyers try to get it back up there to like that 597. So look at how the sellers start to answer now, and you saw a bit of that, and that was enough for me to take it short. I was confident with that right there. And you're going to see the sellers just try to take this down. Look at how the buyers try for it around those 93s, those 95s, and the sellers just won't let them have it. And you're going to see us try here for another leg down. There we go. Boom. Grab those stop losses. Great short trade, and I'm out at 85. So I sold around 90 something, get out around 85, and definitely there was some more there, a lot more. In fact, sometimes it's a matter of patience. Sometimes it's a matter of just locking it in as soon as you can. And you know, there's no perfect world. In a perfect world, you would like it to just go in your favor as much as possible. But at the end of the day, but what you can do consistently is you can lock in profits consistently, of course. So that's going to be it generally. All right, so I've showed you two winners so far. Let's go on to the losers here. So you're going to see how the market is going to eventually break out bearish. And we're trading down in these 540s now. Okay, so now we're trading below the hourly higher low that had formed in the overnight session, being 561. Okay, now right here this is fine. The market is now coming off of its low, rallies all the way back to that 560 mark, and then we sell off again. So that would have been a nice little short again, right off of the moving average, if you want to watch that one really quickly. So the sellers are answering, and you're going to see us continue here. So look at how the sellers just continue, and it's the same sort of thing as before. We trade down to the 540s. Buyers start kind of answering there, but I want to see the sellers continue to answer. And I'm not in a trade at this point, but this is the same sort of trade that I was in before. And look at how the buyers are trying around those 50s. There we go again with more sellers. And we're looking like we're going to break lower. But one thing to note is that as we're breaking these, we're not seeing a whole ton of follow through. So there you go. We traded all the way down to 37, instantly traded back above 40. So it's a sign that the sellers are kind of losing their steam a little bit. All right. So what ends up happening here is that we trade higher and we're in this sort of range. So now at this point, now we're consolidating. You see how the market is in a little bit of a trading range at this point? Right here is when I had to say, all right, if we're not seeing notable conviction in either direction, I'm going to get out of here and go for a walk and let this play out. That's what I had to do instead of sitting here trying to trade every little pop and failure, okay? And that's kind of what ruined me today. Look at how I got short right there. And I got a bad fill because again I got in on a market order. I'm thinking, all right, we're gonna go for a little stop run another time under these 37s. But again, don't forget, remember how we traded down at those 37s before? We traded very quickly and then got responded by buyers. You see, it happens another time there. We trade lower and then we're instantly trading back into these 40s. Not a great trade. That was too impulsive. So that was one of the failures on my part, and just jumping on that too quickly, it would have been the second attempt to push below these lows. And you can see here, as we failed it the first time, and then we came down again and tried it, but that time we couldn't even get below 40. So it was not a good idea to get short right there. Again, because that was the area that those buyers were defending earlier. So why would you get short in front of an area that buyers were defending earlier? When you're doing that, what you're doing is you're front running the idea that those buyers just won't be there. You're better off waiting for the buyers to drop before you short it than front running it into an area where the buyers were before. And what I mean by that, in more specific terms, is that if I saw it trading below the 37s, 36, 35, with a lack of buyers to come and support it, at that time it would have been better to short the thing. Versus what I did, trying to short it here at these 40s, and again, these 37s is where they were defending it earlier. So bad trade on my part, and it's this kind of stuff that I need to get out of my trading completely. This is the kind of stuff that my strategy works weak in. So my strategy is quite strong, but when this stuff happens, that's what kills it. So I need to know when this stuff is happening, just kind of back away from the keyboard, go for a 5-10 minute walk, let it play out a little bit, let the levels kind of come through and let the liquidity come through, and you'll get a better idea of where this thing wants to trade from here, okay? And look at how I shorted it again. So you're going to see me from this moment on, I was on a spiral of bad trades. So you're going to see me try to short it again here. And again, why? So I clearly wasn't thinking correctly at this moment, and I saw that we moved up to the moving average, and now we're trying again to push down. So yeah, I got a little profit, and you're going to see me probably get out of this one break even. Push right back down, sellers are answering. So I kind of like that sellers. Those sellers are keeping me confident to stay short there. But again, look at the size being absorbed on the bid at 46. And down here as well. All of this, and then we pop and I'm out. I took it out before it hit my stop that time, so saved myself a few dollars because it would have gone up and hit it anyways. Anyway, so all of this was just bad trading. I overtraded during this little chop fest, and I had to just simply get out. And again, look at this, another attempt. This is just bad trading. So take my word for it, guys. If you scalp the way I do not trade when this is happening. Just don't do it, okay? So there you go. Boom, hits my stop and I'm out. So take a short when the market's doing this. Just a bad idea. Bad idea overall. So then the market traded higher and I realized I was wrong. And there was one or two other occurrences here. I tried to short that first pullback. Very bad idea as the market pushed immediately higher. So I tried to short that first pullback. Look at how I got no follow through. Buyers start coming in around these 60s. They're very creepy crawly buyers. They're not really aggressive buyers. But the fact is there's no sellers. So the buyers are just going to bring this up if there's no sellers. So there we go. We're trying with the 62s. Kind of playing with it. And then there we go. 65. And then sooner or later I got stopped out of that trade. See, it comes back down. Tries it again. And then I get out that time for a loss. So those three trades was enough for me to stop on the day pretty much. So I was green actually prior because I showed you a couple of those winners. And then those few trades just brought me back to break even at that point. And then I took one or two after this, kind of a couple of other bad trades. So I was on a spiral of bad trades. So let's just look at this. So here I decided to get long. This wasn't bad because the trend is now up, in fact. So I'm trading in the direction of the trend at this point. And you can see how I got out pretty early. I'm shorting it there for a small profit. So at this point I realized, okay, might as well get long. I could fill at the top of that bar. Absolutely horrible fill. And then I sooner or later just stay in that trade and end up with some profit because the market was grinding higher. And then I took my profit and ran. And then I end up with a short here, and at this point this was just a bad short because we're kind of in squeeze territory now, and look at how there's just no sellers. So when we started to trade up here, I decided to take a little short position, and look at how there's just no sellers. Every time we trade down to that 12 exponential moving average, it just gets bought back up quickly. And I was just watching this and I was like, wow, are you serious? Is this really how it's going to be right now? And that's how it's going to be. Yes, not enough sellers, and then I got stopped out sooner or later. I had my stop at 97.50. Let's see where I got filled. I got filled at 97.50, and for some reason I got long right there. Very bad idea. And then I cut it. Yeah, overall, so I think you guys got the idea of the video pretty much. So again, it's just learning about the weak point of my strategy, which is simply don't get short a market in an area where there was buyers present before, because they're likely going to be there again. If the price trades there and they go away, then you can short it. But before the price trades there, don't short it yet, anticipating that they're gonna drop, okay? Same thing with the buyers. Don't try to buy a breakout if there were sellers defending the offers at that price before. If the offers start lifting, then you can look to get long, okay? So that's one of the main things. And the other thing, of course, is going to be just developing the habit in my trading to know when I see these certain types of patterns forming, like this one in particular, where we're below the support zone, not far below it, but just under the support zone. And the market is tightening up in this sort of formation. It's a sideways channel / wedge formation. At this moment, I need to just develop a habit of saying, all right, be patient about it, go outside for a walk for 10 minutes, come back and see how it plays out. Because if you're gonna find yourself trying to take a bunch of mini trades within these things, as a momentum trader, you're definitely asking for trouble, okay? So, all right guys, I think I've shared with you enough in this video. I wish you guys all the best, and I'll see you tomorrow. Take care, bye.